18.
The Reserve Bank's MPC is meeting in a backdrop where the global central bankers are worried about the banking crisis in the US, and we've already seen the Fed introducing some moderation in its hawkishness. As always, CNBC-TV18 Citizens MPC meets ahead of the RBI's MPC to discuss the issues that confront the MPC. I have with me Chairman Pronab Sen and members of the Citizens MPC, Samiran Chakraborty of Citi, Sajjid Chinoy of JPM, Soumya Kanti Ghosh of State Bank of India, Sonal Varma of Nomura, and Dr. Pronab Sen, of course, the chair. Gentlemen, and Sonal, thank you very much indeed for joining me. Sonal, actually, let me start with you. The global backdrop is what we have to discuss first, and as we noted, the Western banks have introduced some kind of moderation. Do you think that that will impact the MPC when it sits in judgment of our situation?
It should have an impact, Lata, because when the February policy was being decided, I think the backdrop looked a lot more favorable with, talk of soft landing, no landing, China reopening, triggering higher commodity prices. Things have played out differently. So on the growth front, with the current banking sector stress, there's still uncertainty on how this actually plays out. The good scenario would be that the policy responses done so far curtail any further increase in financial stress, which is our current baseline. But there is, of course, a risk that as rates stay higher for longer and growth slows, we see more financial risks evolve. But I think the important point is that in either of the scenarios, it is likely that banks are going to tighten their lending standards. Small and regional banks will see their NIM, come under squeeze, and they're lending to the smaller firms or commercial real estate. And I would say just broadly, lending standards, which were already being tightened even before SVB happened, will be tightened further. So the credit channel is going to mean lower bank lending as well as lower growth. And our base case is very much still a recession in US, but also in Europe. We're looking for a mildish kind of a recession, but nevertheless, it is still very much a recession. So in terms of the global growth assumptions that were made in February, now it looks like global growth is going to be weaker than that. And therefore, for India's own growth outlook, it means there is downside risk. Two, I think despite China's reopening, oil prices have not gone up relative to the current assumptions of 95. And therefore, I think given lower global growth and contained commodity prices, which is our view going forward, the risk for inflation, despite the upside surprise in Jan-March, is also to the downside for FY24. And three, the first 2 points actually do mean, in our view, that Fed is largely done with its rate hiking cycle. As far as the external conditions from the current account and the external dynamics are concerned for India, that also looks a lot more favorable today.
Oh, okay. Well, Samiran, what's the Citi view? I think you'll have a more benign view of global growth. Will global growth be so bad that the Reserve Bank will have to take that into consideration and, be more dovish?
So, Lata, first, the situation is very uncertain. It is difficult to thumb the table and say exactly how this is going to play out. But if you just simply look at the global growth picture, the Jan-March quarter growth has been much higher than what anyone would have anticipated. And that's why, despite us downgrading the latter part of the year forecast to some extent, the full year global growth forecast around 2.2%, that remains practically unchanged. The second part is that because things are very uncertain, I think the central bankers across the world are taking a view that we will pick up the pieces just in case something breaks, rather than taking a view that we will act before it breaks. So my sense is that going forward, monetary policy is going to be more reactive rather than proactive in a situation like this, and then we expect RBI to also follow the same pattern.
Okay, so let's then concentrate on the MPC's mandate, inflation. Already the word core inflation has crept into their stance, and that is not showing any decline. February inflation was way higher than what the street or RBI estimated. So Soumya, will that be a very important factor for the MPC, that inflation is not going as per the forecast?
Yeah, thank you, Latana. I think core inflation getting sticky, that story is unlikely to change. We need to understand, but behind this, why it is getting sticky, and that's a fair point which the central bank has been making, because core inflation has been persistently sticky at around 6%. But we need to separate the noise from the data and the wheat from the chaff, whatever you say it. If you look into the period from January 2012 till February 2023, the decade, the core CPI average has been 5.84%. And I can see 4 to 5 distinct phases where the CPI is actually, if you remember, in the early Jan 2012, the CPI was in higher tens, then it collapsed to 4%, then it again went up to 6%, then it again went up, collapsed, and again was at 6%, now it's 7%, now it is 6%. Now, if I just take 2 periods out of this, from January 2012 to February 2015, when the numbers went down from 10.3 to around 4%, and from February 15 to June 2018, when the number went up from 4 to 6.5% whereabouts, there was a movement of around 600 basis points in core inflation, and the transport and communication part had contributed 20% to it. Instead, in fact, that is the story across all core inflation cycles, the transport and communication part contributing at least 15 to 20% of the increase or decline in the core inflation.
So how about now then?
So now the point is that this component is unlikely to go away, because if I understand properly, crude oil going up and going down is unlikely to make any meaning to the RBI inflation trajectory until and unless the government cuts the fuel prices. But that is not going to happen. If that doesn't happen, I think core inflation is unlikely to decline meaningfully to below 5.5% by the year end. So by that logic, if we buy that argument of core inflation becoming sticky, we may have to see several rate hikes, not one in this policy.
Okay, so that's not argument enough to keep the rates, keep on increasing rates is your point. Okay, now we'll come to the growth question. Sajjid, the Reserve Bank's bulletin, March bulletin, seemed fairly confident on the growth story. If you're so confident of growth and your inflation is coming higher than expected, you should hike rates. Are you as confident, and do you think the MPC will be as confident? We didn't get that from the minutes of the external members.
Morning, Lata. Good to be here. I think I just want to first reinforce the global point that Samiran made, that the first quarter of this year is tracking 3.5% globally. Remember, this was the quarter when we were expecting a big recession. And in fact, global growth has accelerated over the last quarter. So there is a certain resilience to advanced economy, private sector balance sheets, which I think analysts have consistently underappreciated. And that has meant that at least advanced economy central banks will pursue 2 objectives and 2 instruments. That yes, if there are financial stability concerns, they will use regulatory tools to get after them. But because growth is holding up so well around the world, and inflation has been so sticky, core inflation has been so sticky, they still have to persevere with their rate hike, which is what the Fed did, the ECB did, the Bank of England did. In Asia, you've seen Thailand, Philippines, Taiwan. So this will have to be horses for courses. I think some of the global strength in the first quarter is showing up in India. We had a strong exports number last month, both for goods and for services. But we have to expect that growth will slow at some point in time. The combination of policy normalization at home and the fact that at some point global growth is going to soften will not bypass India. The question is, will growth soften enough to bring inflation down decisively to the point where it becomes shock-proof? What we've seen is a series of shocks the last 3 years, and each time inflation goes above 6%. The reason I worry about core is that repeatedly we have found that core is your best predictor for future headline, that it's headline that converges to core, not the other way around. So I think the RBI won't be able to take comfort from the fact that because of favorable base effects, headline CPI is dipping to below 6% for the next few months, if core is going to be in the 5.5% to 6% range. Yes, we have to worry about an anticipated slowdown, but the trade-off is there is a probabilistic future. We don't know how deep the slowdown is going to be. We don't know what the disinflationary impact of that's going to be. And you have to trade that off with the current, where we've seen currently sticky core inflation, which is certain. So there's a certain problem at the moment with an uncertain future. And therefore, I think the RBI may well have to focus on the here and the now.
Okay, got that. I think there are slightly nuanced differences over here with Sonal expecting things to be much softer, and Sajjid and Samiran, I think, expecting that both growth and inflation are not going to oblige and could be a little higher. Dr. Sen, how are you looking at the scenario? Is the Reserve Bank to be more worried about inflation, which is their mandate?
Well, there will be. I mean, the fact of the matter is that on one hand, as everybody's agreed, the core is sticky. And the other is, I think we are at the moment looking at a very high probability of food prices going up. And that's something that they're going to have to factor into account. I mean, despite the sort of soothing noises that the government has been making, the fact is agriculture, particularly in the northern part of the country, isn't doing very well at all. So we have to be careful about the inflation story. As far as the growth story is concerned, I think that the uncertainties are too large. But even taking into account those uncertainties, my sense is that the growth is going to soften going forward. And I don't see it upticking to anything really large for a while yet. So I would at the moment worry a little bit more about inflation than I would worry about.
Okay, I'm getting a sense that this MPC is going to vote more in favor of a hike. But just to add to that inflation part, Samiran, there are, what Dr. Sen is pointing out, already milk prices are rising every month, but there are some weather-related fears as well.
Absolutely. So it's not just milk. I mean, we have already got some data on something like tur dal, etc., some pulse prices going up. Sugar prices globally has shot through the roof. And now we are dealing with a February heat wave, a March unseasonal rain, and then we will be looking for whether it's an April-May El Nino situation or not. So the weather-related shocks and its impact on food prices would be something that will be there at the back of everyone's mind.
Okay, so the chances of inflation remaining higher than the Reserve Bank's trajectory is a possibility. On that note, we have to take a break, but we have to understand how this MPC is going to vote on the rate hike and what will be the stance of both the official MPC and ours. All those questions after the break. Welcome back to the deliberations of the Citizens Monetary Policy Committee of CNBC-TV18. I've been speaking with Chairman Pronab Sen and members Samiran Chakraborty, Soumya Kanti Ghosh, Sajjid Chinoy and Sonal Varma. Gentlemen and Sonal, thank you very much for waiting on. Well, the sense I'm getting is that inflation is, according to our committee members, not coming down anytime soon. So, Sajjid, first to you, if the sense is that inflation is not coming down, and the MPC actually hikes, should they keep the option open? Should the stance indicate that it will continue to remain removal of accommodation?
Lata, just to be clear, inflation is going to come down in the coming months. We expect March to be below 6%, closer to 5.5%. That will be helped a lot by base effects. So the first 6 months of the next fiscal year get huge favorable base effects. And then in the second half of the year, things pick up. So there will be some headline relief. The worry is about A, core inflation being sticky, and B, whether the food and weather shocks that others have spoken about will create upside surprises. Now, I think the balancing act for the RBI is, the fact is, we have done more than 300 basis points of hikes. Monetary policy does work with long and variable lags. And so at some point, the RBI is going to have to stop and wait for the previous hikes to filter through, right? And they'll have to be cognizant of that. The problem is that we've already seen that bond yields in India, risk-free rates, have come off because of what's happening globally. And so if one were to hike rates, but either change the stance to neutral or definitively suggest that the rate hiking cycle is down, then the central bank will be trampling on its own monetary transmission, because then you will not get the transmission in markets that you want to get from the rate hike. So I think this will have to be a delicate balancing act where there is some cognizance taken that a lot of hiking has been done, and the central bank is aware of that and will become data dependent going forward. But at the same time, I think still retaining its current stance. So I would expect the existing stance with a caveat. I think a switch to neutral would in a way offset the rate hike itself in terms of the impact it has on bond yields, and on monetary transmission more generally. So I think the stance will be closely watched and will have to be a balancing act if the RBI does decide to hike rates.
Okay. Well, Samiran, if it is 675, then if their 1 year forward inflation is 5.3, there is a fairly high real rate of almost 150 basis points. As of today's inflation also, there is a reasonable amount of, real rate. So do you think they will have to sound even more hawkish in the stance?
So, Lata, our sense is that whatever accommodation RBI provided during the pandemic, that entire accommodation, whether it is on the rates front or whether it is on the liquidity front, that has now been withdrawn. If you look at durable liquidity is already down to pre-COVID level. In fact, over the next month or so, it will fall even further. And if you look at rates are also back to pre-COVID. In fact, if you look at real rates have also moved above pre-COVID real policy rates. So I think it will be difficult for them to keep the withdrawal of accommodation phrase. Now, whether they move all the way to neutral or design a new phrase, that's tough to say, but we think neutral is a possibility because neutral gives you flexibility. It does not mean that you cannot hike from neutral. So if the requirement is there for a hike, they can do it. And what it does also is that in April, May, when the fresh supply of government bonds hits the market, if for some reason there is not enough demand for it and yields start spiking up, so to avoid any contagion effect of that, they can start doing some liquidity infusion operations through OMO, etc. Also, if their stance is neutral. From a withdrawal of accommodation stance, that will be very difficult to do.
That's a fair point. I heard the RBI top guns saying almost no for an OMO, but I guess all central bankers never say never.
And also, we have to understand that the operating procedure of monetary policy, where weighted average call rate should be equal to the repo rate, that condition is also now being met. So we are back to that normalized operating procedure.
So accommodation has been withdrawn by that standard. But Soumya, as the representative of the biggest bank, you would have a better idea of growth. So what if the message goes that we have finished hiking and, Sajid's fear that will undo the good work of hikes? Maybe growth needs a crutch, you think?
So I think, Lata, growth actually has been slowing down. If you look into some of the affordable housing segment, there's a distinct slowdown now, and the housing loan market is now looking more of an asymmetric. You have two segments, one segment which has its own funds and can finance. The other segment is who needs support from the banks, and that has shown a distinct slowdown in the last 6 to 7 months. And there is also evidence of the other books of the banks slowing down, for example, the SME sector. So I think at some point of time, we need to understand take a pause and understand how the effects of the past monetary actions have been playing out. Yes, inflation is still a problem, and to Sajid's specific point on the yields coming down, I can cite that the TREPS rate actually has moved to 670, 675, indicating that an additional 25 basis points rate hike has already been possibly in terms of the liquidity has happened in the market. So my sense is that given, and the final point regarding Samiran's point, you can't have a change in stance and a hike in the same policy, because that will give two signals to the market. You can of course change the stance or change the wording, but doing that will mean that you are actually making the phrase from higher for longer to lower for longer. You are keeping the rates high so that you can cut the rates in future, and that should never be the message to the markets under any circumstances.
Well, we'll have to see how they justify if they hike and go to neutral. Sonal, of all the people, the GDP forecasts of Nomura are the lowest. You think that the Reserve Bank not only needs to give the message of neutral, but there can be cuts in 23?
Yeah, Lata, I think, as Shoma was saying, I think growth, there are clear indications that the cycle has turned. It started out with the export numbers, and more recently it's been the consumer discretionary demand. So affordable housing is one, but paints has been slowing for some time. Retail side is softer. Even on cars, which were holding up, the feedback from dealers for March is that demand is slowing down. And I think within a month or two, we will see that reflect in the numbers. So I think incrementally these spillovers from the global side, but also the impact of domestic tightening do mean we are underestimating growth. So our projection at 5.3 is below the RBI's forecast of 6.4. On inflation, Lata, I would also sort of differ from the current expectations. I think clearly the Jan-March inflation surprise on the upside. A good chunk of that was actually because of cereals, which is more technical. It does not in any way actually change the FY24 trajectory for inflation, which is, in the worst case scenario, 5.3, but more likely in our view is going to end up being below 5% for FY24. I think the forward-looking inflation trajectory is also looking softer. Commodity prices are down. Global growth outlook is looking weaker. Domestic lead indicators are pointing to a slowdown in demand. We know monetary policy works with lag. So the decision today cannot be based on yesterday's data. It's high time policy becomes forward-looking.
Fair enough. Dr. Sen, finally to you, sir. Your team seems divided, but what do you think the Reserve Bank should indicate in terms of guidance?
No, I think the Reserve Bank is in a position where they will have a lot to say. I mean, I think a lot of their discussion will have to center around what's happening to the global economy and what it means for India. I think that's going to take up a large chunk. In terms of what they say about the conditions in India and the sort of the probabilities of growth going up, I think they would be a little cautious.
Oh.
The real question is what are they going to say about inflation? Now, the fact of the matter is, yes, we do know monetary policy works with long and unpredictable lags, but the fact of the matter is that inflation simply has not reacted to the monetary policy that has been carried out for the last 2 years. Now, can the RBI take the position that we are looking forward, and hopefully the cumulative effects are going to show up this year? I doubt whether they will do that, which doesn't, of course, mean that it changes what I think, because in my personal opinion, the repo is already too high, and the inflation management should look at other instruments. But I don't think the RBI will look at it that way. What they will be doing is, we are in a situation where the global banking crisis is going to roil up the financial markets, and we could be looking at a possibility of there being a flight of capital. So that kind of discussion is going to be out there, and I think they will react.
Okay. Okay, now that's another item I didn't introduce simply because I thought the current account deficit also was last year's problem. But we don't have time for that. We have only time for vote. So please get ready to tell us what you expect the MPC to do on the repo rate. Samiran Chakraborty, you go first.
We think it's a 25 basis point hike in repo.
Okay.
Yeah,
Soumya?
we think it's a pause, but the RBI may do a balancing act.
Okay,
but
pause. We have to go only with that.
Yes.
Sajjid?
We think a 25 basis point hike.
Okay, and Sonal?
Pause.
Okay. Dr. Sen, the team is equally divided. Yours is the casting vote, sir.
Well, if I were voting myself, I would say pause. If I'm predicting what MPC is going to do, I'll say 25 basis points.
Okay, so it's a 25 basis hike. The hikes win. Let's look at the stance. Samiran?
We think a change of stance, probably to neutral.
Neutral.
No
Soumya?
change in stance.
Change to neutral.
No change in stance.
No change in stance. Okay. No change in stance from Soumya's. Sajjid?
Something intermediate between what their current stance is and neutral.
Okay, but you're not voting neutral.
No.
Okay, not neutral. So I would say retain with tweaks. Sonal?
Retain stance.
Dr. Sen?
For precisely the same reasons Sonal mentioned, I would say neutral, because I think they have to be a little less decisive than retaining stance would imply.
Okay. All right. So even this is actually quite narrowly divided. The chairman is on the side of neutral, but not all members believe that the word neutral will be announced. It clearly looks like it's going to be a contentious MPC. And who knows, maybe the governor will have to use his casting vote this time. Wrap up on this special edition of the MPC. Thank you for watching.